Welcome to the Broken Pie Chart Podcast, episode 128. I'm your host, Derek Moore, and this week, what are we talking about? Well, we're going to ask the question, or try and answer the question, are historical returns useful or useless to investors? I mean, what can you actually derive from these? What types of things can you take from? How far back can you go? Are there any problems with using historical returns? And this really came about a few listener questions who've been asking this. And really it came about more of, hey, look, on the bond side of this, when I'm looking at these historical returns on bonds, but bonds aren't really paying anything in interest right now. So I thought, why not do an episode on this very aspect? And when you think about historical returns, it's easier now to get these. So let's just, think about the S&P 500. And you can go back now, looking online, and there's different data sets. One of the ones that I like to use is Professor Aswath Damodaran at NYU. I'll link to his website, his blog. He always puts out some interesting content. And by the way, he if you ever want to know anything about valuation, he's quote unquote the dean of valuation, they call him. So he teaches in the NYU Business School, and he teaches intrinsic valuation, discounted cash flow, all that stuff. He puts some different content out online as well. But his data, I believe, goes back to either, 1926. I should have looked at it before the podcast, but around 1926 or so. Rather recent in a weird way. I know it's getting on 100 years now of data. The other data sets that are out there, I'm not sure if he updates it anymore, but Yale's Professor Robert Shiller, and I remember he wrote the book, what was it called? Irrational Exuberance. I'll put a link to that book. But he did a lot of work on the historical side. I don't know. I'll put a link to his data. I'm not sure if he still updates it, but he had stuff back to 1871. And then Jeremy Siegel, I don't think it's online anywhere, but he wrote a book, Stocks for the Long Run, and he's a professor at Wharton, which is the business school at Penn. In his book, he went back to 1802, and he looked at stocks, bonds, bills, gold, the U.S. dollar, and then of course the Shiller data and the Damodaran data. They look at stocks and bonds and bills as well, but he didn't publish his data, not that I could find anywhere. But I remember in the book, he put, he went back to 1802. Interestingly enough. And I think he's talked about, this data, and is it reliable? Is it not reliable, right? You think about trying to find data from, imagine trying to find something from, 1805. It's not like everything was just online back then. But Jason Zweig, it's got to be a long time ago, he actually had a conversation with Professor Siegel about the data. And I think some of it was estimated. Some of it was based upon samples. But anyway, so then the other thing that you look at with all this stuff is we'll think about when you look at, most of the time they have something, total return. So total return just means it includes the change in the underlying market value, but it also includes dividends that were paid and sort of assumes that those are reinvested. And there's an interesting challenge with that as well. And then sometimes data is presented as just nominal returns. Nominal means not adjusted for inflation, or it's a real return, and that's adjusted for inflation. So that's just a fancy way for saying, look, if your stocks went up 10% one year, but inflation went up 10%, you actually didn't, on a real return basis, you got zero because all of your return was eaten up by inflation. So it kind of depends on that. So when we look at the S&P 500 data, and later, one of the things I want to do with this episode too, I want to talk about probabilities of certain returns. And I also want to discuss sort of the issue in the bond market where a lot of these historical returns had periods of much higher interest rates. And so that's kind of a challenge. Of course, I can always refer back to the power of compounding, and that's true. But I do want to spend a little bit of time on probabilities. Now, before we get into, I want to get into some of the numbers and then go through some of the issues. But it's worth mentioning, right? Anytime you get an investment perspective or a tear sheet or anything like that, so you always see this disclaimer, historical returns are not indicative of future returns. Past performance is no indication of future results. And yeah, that's absolutely true. And by the way, you know, and everyone who's listened knows that, we're big advocates of hedging. And so, trying to time the market, it's not really, I'd rather see people be in the market, be properly hedged. And obviously it depends on everyone's situation. But, when you have hedges, it takes away some of this guesswork of trying to figure out, is the market undervalued, overvalued? But just on a historical perspective, I'll give you some numbers. And I wrote an article at the end of, let me see. Actually, this is in January of 2020. I wrote this, and I'll put a link to this. This is on the zegafinancial.com site. And I looked at, and I said, what were the compounded annual growth rate by the decade? And compounded annual growth rate is a total return. It's nominal, so not real. Does not account or adjust for inflation. And so the 2010s on the S&P 500, 13.33%. Great. That's great, right? Remember, the rule of 72 says that if you get, around 7.2% compounded annual growth rate, you would get a double over 10 years. And so that's almost, twice that. So in the 2000s, and this is interesting. So I went back to the 1900s. Only 2 decades had negative total return, 0.12% in the 1930s. And then, of course, you had negative 0.99%. Let's just call it negative 1% in the 2000s. Of course, in the 2000s, you had the tech crash. You also had 2008. So despite all that, it was a lost decade where, if you didn't add any money, didn't take any money out, and you just put it in the beginning of the decade, at the end of the decade, you had sort of annualized 1% loss every year. But all the other decades were, some were better than others, but, 1950s plus 19.6%, 1980s, 17.68%, 1990s, 18.30%. So just to kind of give you a perspective there. When I went back and I looked at the data, and this goes back to, 1928. So I say 1926 for the modern NYU Stern data. I meant 1928. So, and by the way, there's a nuance here. When you look at simple average just takes all of the years returns and divides by the, it's just the simple average, right? When you look at a geometric average or a CAGR, a CAGR, compounded annual growth rate, that's sort of more representative of what the investor actually realized. And that doesn't account for money coming in, money coming out. That changes the calculus there. But, the compound annual growth rate, 1928 through, and I did this through 2020, good news, right? Average annual compounded growth rate, 9.79% on stocks. So the numbers have been, pretty positive on stocks. Obviously, depending upon when you invest, like I said, I just went through the decades, right? If you invested in the 2000s, that was kind of a flat decade, right? Negative 1% annualized compounded growth rate, but over time. So let's kind of, okay, and here's the other issue with, so here's sort of an issue with these. And I'm going back to 1928. I mentioned the Shiller data. I mentioned the Siegel data. So up until the 1970s, I think it was late 70s, you couldn't buy the S&P 500 in a fund. There was no fund. There was no index fund. And I think Vanguard was the first one who did this. I think it was the late 70s, where you could buy a mutual fund that created, in the same weights and proportions of the S&P 500, the index. So you put, $5,000 in it, you buy the whole index. And I believe you could do dividend reinvestment within that as well. And so remember, total return accounts for the change in market value, also the change in or accounting for dividends paid out to you. So, but one of the issues though, if you're looking at data from the 30s, 20s, 1800s, right? There was this thing called commissions. Commissions are zero now, but they weren't always zero. And they were certainly lower once the internet trading came about. But I can remember placing trades in the 90s and, buying 100 shares or something. And it was like, I don't know, it could have been $50, could have been $100. There used to be these formulas dependent upon the shares and the value. But let's just look at this. So we know that you couldn't have bought a mutual fund until the late 1970s, S&P 500 index fund. It wasn't until I think it was the mid 90s, maybe 94, 93, that the spiders came out, the SPY, which is an ETF, which with one click now you can buy the entire S&P 500. Those products weren't available. So think about this. If you wanted to buy all of the stocks in the S&P 500, imagine you buy 500 stocks, 500 shares, 500 different positions, and your commission was $50 a share. It would cost you $25,000. $25,000 to buy those 500 shares. 500 companies. And if it was $100, commission per transaction, let's say. Did I say share before? $100, it would be $50,000 in commissions. So think about that. You buy 500 companies. If it's $50 each, $25K. If it's $100 in commissions each, it's $50,000, right? And then if you get paid a dividend and you want to reinvest that, there was really no mechanism to do that. So you would have to go out and take that dividend payment and then buy corresponding shares. And you couldn't buy fractional shares. I remember there used to be those TV commercials where I forget what the firm was, but you could buy a list of all the companies that did free DRIP programs, dividend reinvestment plan, DRIP, right? And I think it was, I don't know, maybe 100 different companies or 200 different companies, but you could buy shares directly from the transfer agent, meaning if there was back then physical certificates were held by what's called the transfer agent. They weren't held in a street name at a brokerage firm. And so, you could send a check to them and then they would invest in free way of getting the shares, and then you can invest dividends, right? But anyway, my point of doing that is I think it's okay to use total returns and historical, but I do think it's important to point out that a lot of the stuff that we do today wasn't available back then. So just a little aside there. So here's where I stand on historical returns. Look, historical returns, and I think there are real benefits to looking at historicals because they inform our opinion and help us understand historically over a long period of time how volatile an asset has been. We can compute the compounded annualized growth rate. That's very good. The more years or the more data that you have, the less, standard error. So standard error is just a fancy way in statistics for, depending upon your sample size, how big is maybe the variation in your average. I'll leave it there. I don't want to do a whole statistics podcast. You would turn that off really quickly. But I think there's value in these. And I think you can look at these. And I think the good news is that over time, stocks have provided a good return. And we look at the compounded annual growth rate. We look through the different decades. And the good news is most decades were positive, going back to the 1900s. And the ones that weren't awful. Certainly if you were, depending upon your timing, right? But that's the good news. And that's one of the reasons why, since we don't know what we're going to get going forward, that's the value of using a hedged equity strategy, as I've been talking about for a couple of years now. That's the value of actually going in and saying, I'm going to buy the market, but I'm going to have some hedges to the downside in place. So maybe I give up a little bit on the upside, but I limit my downside, and that takes away sort of the timing aspect. And this really matters too, depending upon where you are in your investment life cycle. If you're young and just starting out, just periodically put money into a fund, and you probably don't need any hedges. Just keep doing what you're doing. If you have a base of assets, or if you're getting towards the latter part of your career, early in retirement, then a lot of this stuff becomes really important. So I think it's the other thing that's interesting is that you can see you've got reference points, and so everyone always asks us, "Hey, how'd you guys do in 2008?" or "How'd you do in February or March of 2020?" So it can provide a little bit of a reference point and somewhat of a little bit of a stress test. Now, the other side of this too is that, let's look at 2007, 2008. If you would have looked at historical drawdowns in housing prices or the probability of housing selling off that much, there probably wasn't a real high probability of that happening. So sometimes these things come up, and look, it's a different situation that causes an issue, and you really don't have any historical precedent for that. Now, where I do think historical returns pose a little bit of an issue is in the bond market. And look, when I wrote my book, Broken Pie Charts, by the way, what a great Labor Day gift that would be for anybody that you know, or even somebody you don't know. Just go ahead and buy the book, and Broken Pie Charts on Amazon. Who doesn't give gifts for Labor Day? Anyways, so when I wrote that book, I pulled data down from the Bank of England on historical short-term rates. And, look, they had information going back. I think it was back to the 1500s. I'd have to look in my chapter in the book. If you get it, you'll have that chart, by the way. So I'll put a link to it in the show notes. Great Labor Day gift. Never too early to start shopping for Halloween. Give it out, as kids come to the door, why not give them a copy of the book? Start them out investing early. But the challenge with the bond market is a little different. And the reason why it's different is that, I can look and I can, go back and say, and I'll just tell you what the numbers are. If I look at, let's say, something like the 10-year Treasury bond going back to 1928, the geometric average or, compounded annual growth rate is just south of 5%. And, where a lot of these 60-40 portfolios, guess what? They might be using historical averages, right? Like that. But what's different right now? No surprise here. It's the interest rate. And right now, the 10-year Treasury is around 1.25%, something around there. So, you go back to the late 1970s, and I know what you're going to say. That's a different period. We had inflation. Absolutely. But, you had treasuries yielding 10, 13%. And so on a total return basis, where you have not only the change in the market value, but you've also got the interest that's paid, much like a dividend is paid in stocks. And we're certainly in a different time period right now. The other thing with bonds and treasuries is they have this sensitivity to interest rates. So when you think about a treasury bond that was paying, 10% back in, or 7% back in late 90s, right? So you have this bond that's paying 7%, and its sensitivity to changes in interest rates is much less. Now with bonds rates so low, any change in interest rates is going to have a bigger impact on the underlying market value of that bond. And so we've never had rates really this low for this, certainly since 2008, we've had really low rates. Rates hit, unbelievable lows in 2020. They're still really, really low right now. So I do think this is one of those things when people start evaluating a 60-40 portfolio, 60% stocks, 40% bonds, where they sort of run metrics on, expected return and all this stuff, and they're including many years of bonds that have much higher yields. I think it does become a little problematic. I'm not saying bonds are going to go down by quite a bit. I will say that the modified duration or effective duration, which is really the sensitivity to interest rates or changes to interest rates, has never been higher. So, if we did get a material uptick in rates, you would see bonds, go down. And I think we saw that in the first quarter of this year when rates spiked. I mean, the 10-year, what did it go from 0.7 to 1.6% or something like that? And I think the bond market had its worst quarter since its worst quarter in 100 years or something like that. So, I do think that's a little problematic to use all that stuff. But we just don't know. I mean, the numbers are the numbers, right? And I'm not saying you shouldn't own bonds. I'm not saying you should own them. Should own them. But I do think it's just something to keep in mind. The other thing that historicals can do is they can give us probabilities. And so we know that if we have, just if we use the simple average, right? And we sort of look at historical annualized returns, we would say, and by the way, the simple average on the S&P 500 was about 11.64%, the way I ran it. And so right at the average, we would say there's a probability of about, 50% probability that you would get that return. And the probability of getting a return here, looking at these numbers here, a 40% return in a given year of a simple average, right? You have about a 7% probability. Probabilities are not certainties, right? But it was interesting, though. You remember at one point in 2008 to 9, the S&P 500 was down about 55% or 50%. The probability of being negative 55% is 0.03%. Simple probabilities. I didn't do any, fancy normal distribution, right? For those of you listening who have a background in probabilities, this is sort of back of the envelope stuff, right? But we know that happened, right? And that goes back to the idea of having protection in portfolios, either buffers or hedges, in case you do get those outlier years. By the way, the bond market is interesting because the bond market returns are much more, you don't have as great of a distribution. In other words, the left and the right tails aren't quite as far out. But if you look and you say, what's the probability of bonds losing, 10% in a year? It's only 2.29%. So, and by the way, if interest rates went up, a little bit over 1% from here on a 10-year bond, you would expect to lose almost, 10% from there, right? So kind of give you a little perspective on probability. So maybe I'll do another episode just on probabilities. Maybe not. All right, so what can we say from, are they useful or useless? I think historicals, if you've got to look at a couple things. And I think I already explained the bond situation, where if you're using data that has different periods that are really different from today, maybe, having those in the historical return isn't quite as helpful to you. But I do think with enough years and enough data sets, enough data, you have a pretty good idea of sort of what's happened in the past and it also can inform your knowledge about the future. And the caveat always is you just don't know. You don't know, are we going to get an outlier year in 2022 or this year or whatever? Or are we going to get more of a normal year? I will tell you that the stock market is up more than it's down. And there's been a lot of times where you have intra-year drawdowns that wind up being positive, which is quite interesting. So I think they're helpful. But like I said with the total return thing and the dividend investment thing with stocks, you just couldn't do that. So, if somebody said, well, if I would have, bought the S&P and reinvested my dividends from 1950 to 1970, yeah, you probably couldn't do it. And it would have cost you so much in commissions and the fees for dividend reinvestment, and I would have had to buy all these stocks. And by the way, the funds, the ETFs and the mutual funds who mirror the S&P or other indexes, it's based upon an index. When that index, the weights change or members come in and out. You remember the whole big deal about Tesla joining the S&P 500? Those indexes have to trim shares, add more and others to make sure the weighting is the same. Imagine, I just mentioned those commissions. Imagine if your portfolio, all of a sudden, you had to make changes to adjust the weighting, or you had a couple people go out, a couple people come in, meaning companies, not people, but companies coming in, companies coming out of the index. You've got to buy and sell those. That's sort of every time. So it just really wasn't cost effective. But one of the lessons, though, I think is important to sort of express is the value of compounding is still there. And I mentioned earlier the rule of 72. Quite simply, it means if you take 72 and you divide it by your return, that's how many years to double. And by the way, if I know if you take a financial calculator and you multiply, let's say, an amount of money times, and compound it at 7.2% over 10 years, you'd be like, wait a second. It gets us a little more than that. Yeah, that's right. It's not a perfect, absolutely double. But going back to the historical returns, the power of compounding is real. And the power of compounding, for those that don't understand that concept or are not familiar with it, it's just, if you have $100,000 and then you do get around 7.2% a year and you compound to $200,000. Well, now if you get another 7.2% over the next 10 years, then you go from 200 to 400,000 because your base of money was higher. And so it sort of snowballs on itself. And that compounding effect is pretty powerful. And if you're adding money on a periodic basis, it also helps things to grow. And by the way, if you're adding money on a periodic basis, in theory, you're buying less when the market's high and buying more when the market's low. And on the flip side, and I keep saying it again and again, the reason to have some protection or buffer in the portfolio is that the less you lose, the easier it is to come back from it. We know that if you take a 50% loss, you got to get 100% to get back to break even. The less you lose, the easier it is to recover. And so compounding is real, compounding is powerful, and risk management in portfolios, hedging or buffers, is also really powerful. Because the less you lose, the easier it is to come back. And the less you lose, as you get any sort of comeback in the market, you actually can outperform quite a bit from for someone who took a really big loss. It takes a long time to get back. So, all right. So for this episode, remember my book, no, that's Jay's book, Buy and Hedge. Buy that one too. Buy two. Broken Pie Chart on Amazon. I'll put a link to that if you come shopping for Labor Day. I'm joking. I know nobody buys Labor Day gifts, but anyway, I'll put those in there. And I've got a lot of this historical return data in there. I've got the charts, the probabilities, all that stuff from Stocks and Bonds. So I actually published that. And then rather than wasting time rating, reviewing, and starring, go ahead and share this episode with someone who doesn't listen to podcasts. You got to teach them how. You got to show them what apps to use and all that stuff. Or somebody who does listen to podcasts, but go ahead and share it and keep the ideas coming for future shows. We're going to have some guests coming up in subsequent weeks. I'll let you know who when it gets a little closer, or you'll just see the episode drop. And I think Jay's going to come back as well, my semi-permanent co-host. We'll probably do something in the next few weeks as well. So, all right, folks, have a good weekend or have a good week, and we'll talk to you next week.